Hello, welcome to my YouTube channel, your space to understand debt, credit, and everything in between, replacing fear with facts and helping you understand these topics in a clearer and honestly a simpler way. Today, I'll take you behind the scenes into how lenders generally make credit decisions and why understanding the process can help you feel more confident every time you apply for a credit facility. I'm a credit risk professional with over 15 years of experience in the banking industry, from shaping consumer lending policies in my earlier roles to portfolio management and to designing debt collection and recovery strategies. I do share practical insights drawn from my experience, and everything here is purely educational, not meant for personal financial advice. So, here you are, you filled out the loan application form, hit the submit button if it's online, and now you are waiting. What happens next? Who decides if your application will be approved? Is it a person or a computer or both? For most lenders, there's a rhythm. There's a mix of data, systems, policy, and people that turn an application into a decision. And this is part of credit risk management, and it's designed to make lending fair, consistent, and sustainable over time. So, when your application arrives, whether online or physically, it will go through several stages, all guided by the bank's lending policies and regulatory requirements. So the first step is that there will be information collection of what you've provided. And this is where the lender captures your details in their system so that they can begin assessing your application. This will include your identity information, your income and supporting documents, your declared expenses, your declared debts, and the purpose of the loan. The next stage will be for your lender to pull the credit report from approved credit reporting bodies. The credit report will generally show your repayment history, if there's any late payment, if there are any defaults, what's your credit score or credit rating, and financial hardship information in case there's any, and your credit limits. It's like your credit reputation on a paper. Then the next stage will be serviceability assessment, where the lender will look at if you are able to afford the debt. And this is where number crunching actually begins. The lender takes your verified income, compares it with your expenses and the verified debt commitments. Your expenses will also be compared against the industry benchmarks to make sure they are realistic, not underquoted. They will then apply an interest rate buffer to check if you could still manage repayments within the allowable loan term if interest rates rise in the future. And the allowable loan term will take into account your age, your remaining time in workforce that gives you ability to service the loan. And if you expect your financial situation to change soon, like a new financial responsibility, then it's important to also declare that early so that it's accounted for and does not affect you later. If at this point the numbers don't add up, the lender will consider the loan unsuitable for you. Then the next stage will be the credit risk assessment to check if you will repay it. And this step is different from the serviceability check, which we've discussed previously. Serviceability will look at whether you can afford the loan. But credit risk assessment will look at whether you are likely to repay it. And at this stage, the lender considers your credit score, your past repayment behavior, how stable your income is, and how much debt you already have. Each lender has its own lending policy rules, and in most cases, these checks are done automatically by their system without a person needing to step in. In most cases, not all. If your application meets those lending rules, then it will go through an automated application scoring system. This system uses models built on data from thousands, sometimes it's millions, of previous applications to estimate how likely you are to repay the loan. It's possible that you can pass the basic lending policy rules of the bank, but still fall short at the scoring stage, which may lead to a decline or a referral to a credit manager for a closer look. But here's the interesting part. Two banks can look at the same application and reach different decisions because their policy rules and scoring models aren't identical. Although I think for most people, the outcome could be similar. If something in your application needs more context, like a recent job change or irregular income, or even ability to service the loan post-retirement, then a credit officer may manually review it before a final decision is made. And if you have a secured loan like mortgages or car loans, the lender will also assess the security. The property or the vehicle being financed, they will look at its value, its condition, and whether it provides enough coverage for the loan amount. If the security isn't acceptable, the loan may not be approved, even if your income is strong. Unless otherwise, there are other risk mitigants that have been considered. And once all these assessments are complete, the lender will then step back and ask the final question: is this loan suitable for you? Does it meet your requirements and objectives? Can you repay it without falling into hardship? And in the case of secured loans, is the security appropriate? This final check will ensure the loan aligns with the responsible lending obligations, and it's called suitability assessment. When all the checks have been completed and the loan is suitable for you, the lender will then make a decision. The application is never just approved or declined. Sometimes you'll receive a conditional approval, meaning your application somehow looks promising, but the lender needs more information or needs certain steps to be completed. They may also ask for risk mitigants like a guarantor or insurance, depending on the situation. And conditional approval isn't about distrust. It's about responsible lending. The goal is to give customers opportunities while also protecting them from overcommitment so that both sides are better off in the long run. If your loan is approved or your facility is approved, you will receive a contract and legally required disclosures. For unsecured loans, once you sign, funds are then released to you. For secured loans, there is an extra step for security registration and settlement. But here's the truth. Lenders don't enjoy saying no. A decline usually means something didn't align with the lending requirements. And it's not that you, as a person, you failed. Sometimes, after yourself reviewing your situation, you might notice small changes may be required in future in order to improve your credit application outcome. And if you are unsure why you were declined, you have the right to ask. And that's part of transparency and responsible lending. You have the right to ask. So, next time you apply for a credit, loan, card, remember, behind that decision is a process built to balance risk, fairness, and trust. And there is a mix of data, their systems, their policy, and their people that turns an application into a decision. Understanding how lending works means you can navigate it with confidence each and every time you apply. If you found this video useful and you'd like to continue learning more with me, then like and subscribe so you can always be notified of my new videos. In the next video, I will share with you some signs that show you might be overcommitted and how to catch it early. This content is general in nature and does not constitute personal financial advice. Please consider your own circumstances and seek help from your lending institution or a licensed financial advisor. Thank you.